You are by far the most academic person to have joined us, and also the one with the most credentials who has ever joined us on the podcast.
The bar is very low.
Yeah, exactly.
After my PhD, I was a professor of finance in the US. It just so happened that one of my advisors went to Goldman Sachs and he gave me an opportunity that I couldn't refuse. So
Goldman opportunity, usually you can't refuse.
yeah, exactly. I had been in the US as an investor in real estate, and as you know, real estate in the US is very organized and formal market. So I always felt that real estate is an important driver for the economy, and there has to be a scientific analysis of the sector. And here is an opportunity to build something from scratch. If you multiply by the number of small and medium businesses that we have in India who are sitting on land, I mean, you're looking at huge lakhs of crores of capital unlocked. And here is an opportunity for these platforms to actually disrupt the investment banking business.
Yeah.
I mean, if you think about it right now, I mean, the whole distribution is all very archaic, it's very network based. So if you use technology to break up, then this can actually be another vehicle to bring change to the financial market.
And in India, who loves buying real estate? We all like real estate. We like buying the physical assets.
Kind of a unique product to India, and I think it's actually, in my mind, it's a perfect product for India.
Yeah.
As I was saying earlier, this is a necessity for a capital-starved mid-India.
We are in the eye of the storm, so to speak. So we will see firsthand whether we'll be swept away or whether we will kind of rise above, and become like a regulated product that suddenly disrupts the market and retail investors get access to something they've never got before. It's pretty much inventing a new asset class that the regulator has done on the back of what the FOPs have been doing. On 8th March 2024, SEBI notified the SM REIT regulations that is set to bring a revolutionary new asset class to retail investors. Compared to a REIT, an SM REIT allows investors to participate in smaller but higher yielding assets, a market that has thus far been served by fractional ownership platforms. A recent research by PropShare and JLL indicates that this could be a multi-billion-dollar asset class with the potential to monetize large but disorganized real estate that is currently too small for mainboard REITs. Hello and welcome to another episode of the PropShare Podcast series. Today we are in conversation with Professor Venkatesh, fondly known as Prof. Venky by his students, who is faculty head of the Real Estate Research Initiative at IIM Bangalore, and someone who has been very closely associated with the SM REIT and the real estate industry. Professor Venky has been working with SEBI and key industry players like PropertyShare to ensure that the new regulations help develop a successful market for this new asset class. He has more than 20 years of experience in academia and in global financial services, including the world's largest hedge fund, Bridgewater Associates, and Goldman Sachs in New York, where he worked prior to joining IIM Bangalore. Professor Venkatesh is a chartered accountant by training with an MBA from IIM Calcutta and a PhD in finance from the University of Southern California. Professor, thank you so much for joining us on this podcast.
Thank you, Kunal. Thanks for bringing me here. I'm happy to always talk about some of the things that I enjoy talking about.
Absolutely. And you are by far the most academic person to have joined us, and also the one with the most credentials who has ever joined us on the podcast.
So it gives me, the bar is very low.
Yeah, exactly. I don't think we've had a PhD so far on the podcast. Right. So I'm really excited to kind of speak about SM REIT and also a little bit about real estate, which I think both of us really love. It's a subject that we like and we've been involved with for some time now. Just to start off with, how did you decide to join academia, after having worked with some of these big asset management companies like Goldman, Bridgewater?
Yeah, no, it's a good question. I think, I was an academic to start with. After my PhD, I was a professor of finance in the US. It just so happened that one of my advisors went to Goldman Sachs, and he gave me an opportunity that I couldn't refuse. So
Goldman opportunities usually you can't refuse.
Yeah, exactly. So I think, and those were the days. These were pre-global financial crisis days. So things were looking very good in Wall Street, and so I learned a lot. And of course, from Goldman, I moved to Bridgewater. But then, for various personal reasons, we decided to come back to India. This was in 2011, and both me, my wife, and the family, we were not sure whether, after being there in the US for 22 years, we could survive. So we thought we'll try it out. So there was a 1 year of soft landing where I took a visiting position at IIM Bangalore, and we wanted to be in Bangalore. And so it started that way, as I was back in financial markets and finance department in IIM Bangalore. But then in 2012, we had an alumni who was a developer who offered a chance to start something in real estate.
Okay.
But this was not offered to me directly, but it was offered to the institute. And at that time, the director looked around and said, "Who wants to do this?" And as you know, real estate is not an area where everybody wants to be in.
Yeah.
And especially in 2012, I think none of the faculty showed any interest. And so I was just fresh off the boat, and so I thought, why not? And I had been in the US as an investor in real estate. And as you know, real estate in the US is very organized and formal market. So I always felt like real estate is an important driver for the economy, and there has to be a scientific analysis of the sector. And here is an opportunity to build something from scratch. And I had built something like that in the US for a different purpose, like completely greenfield opportunity. So I didn't want to miss that. So like a naive professor, fresh off the boat, I raised my hand and I said, "Let me do it." And since nobody was interested, the director said, "Okay, here it is, take it." And now I'm still stuck with it.
Right.
Yeah, so that's how my journey started.
You answered the second question, which I wanted to ask you, was why you chose
Real estate.
You've kind of done your PhD in finance. You're a chartered accountant by profession, by education, and then you also did your MBA. So this is how you got into.
Actually, the thing is, initially the real estate in India, as you know, in 2012 was only the physical side of the real estate market, not the financial side.
Yes.
And in the US, I was involved in the financial side, both REITs as well as structured products. So it was more interesting for me to use the experience of the physical market and then try to build something on the financial side. Because, for example, all the securitization and so on, right? That didn't happen too much in India at that time. So that was actually the holy grail that I was after.
Yeah.
Because I wanted to be involved in the securitized side of the market, and here was an opportunity to know the market. So that's how it started. But I can talk about that if you want me. But
go ahead.
No, but I'm saying that in that initial space, it was largely, we didn't know what to do.
Yeah.
Because typically researchers want data. Because I am an empirical researcher, and so I can't just make views or opinions off the thin air, right? You needed some data. It's very hard.
Is known to have no data, very little data.
Absolutely. So I think data was a big issue. So my first stop was, okay, let me take a year off to build data sets. Yeah. So that's when we started working with governments. Right. So for example, my first project was with Government of Karnataka on trying to estimate guidance values using scientific modeling. So that was an opportunity to get data from them. Similarly, we worked with, for example, the National Housing Bank, which used to be the regulator at the time for all housing finance companies. So they gave us mortgage data. Okay. So that's how we slowly started collecting different parts of the data. And but initially it was all governments. I was not involved with the industry or anything like that. I would say about 3 to 4 years just doing projects for governments on how do you create affordable housing policies, what would be a tax efficient way for governments to monetize their assets and so on.
Right. I mean, in hindsight, if you think about it, it was a very good time to join or start something in real estate, 2011, just before securitization, which according to me in India happened when REITs were finally introduced. That's when India started securitizing real estate in a meaningful manner. Because until then, there was no
Correct.
way to securitize real estate. It was physical real estate. You can buy an apartment or maybe a villa or a small office if you had the money to do it. But other than that, you could have a security that backed a real estate asset.
Correct.
And that's what we struggled with at Blackstone, where we built such a huge portfolio. We invested $3 billion, became the largest office landlord in the country. But there was no way for us to exit because nobody would buy a $3 billion value portfolio from us.
Yeah.
So then we went to SEBI and said, look, there's something called a REIT in the West. And this is exactly what it's for. Can we work together to start a REIT in India so that people get access to a securitized real estate product? And then, of course, the whole REIT thing. And then it took 3-4 years till the first REIT, which was a Blackstone REIT, to kind of come. So, in a way, it was...
actually, there was one other thing. See, there is a securitization of the physical market, and there's a securitization of the financial side, which is the mortgages.
Yeah.
So, for example, in India, a lot of banks sit on these mortgages and keep them in their balance sheet forever.
Yes.
So, one of the things, early work that we did was how do you get banks to get rid of some of these mortgages, monetize them, and then put again that money back into the housing market.
Yeah.
And believe it or not, you would think that coming from the US, this was a no-brainer, right? That's how Fannie Mae and Freddie Mac was built. But Indian banks didn't want to get rid of them because that's probably the safest loan in their balance sheet.
Yeah, exactly.
And they didn't want to give that up. So it was an interesting challenges moving from the US to India.
Right. And real estate as a course, like you yourself mentioned, is not something that's very popular in India. You don't hear real estate as a course being taught. You don't even, I don't think you have a degree in real estate. If you go to the UK, the University of Reading is actually a university focused on real estate. If you want to study real estate, you go there. But in India, real estate as a subject has never really picked up. People feel, maybe they have a negative connotation to real estate, but when I did my MBA at IIM Bangalore, there was no real estate course or anyone teaching. At least now there is one professor who's teaching.
Correct, yeah.
But, how do you think now this has evolved and this has become a subject worth teaching and people to come and listen to you talking about real estate?
See, the thing is, you have to imagine how it is. And as you know, you are an MBA from IIM Ahmedabad. I did my MBA from IIM Calcutta. People come largely to go get a job. So in that respect, real estate was not a very attractive place to get a job.
Right.
So given that was not there, the interest also was very low because there's no reason why I should learn something where I'm not going to get a job. I think that whole transition happened after people like Blackstone and others coming in on the financial side.
Yeah.
And we also had a lot of corporate developers like Godrej and Lodha and others who started to come to campuses and start recruiting 1, 2, 3 people.
That's how
and then once one of our students goes and works in Godrej, they get the feedback back to the next batch, to say, hey, this is not a bad thing. I'm really enjoying. And that's how slowly the transition happens.
Yeah.
But
Blackstone,
now I think
Blackstone played a big role in this.
Yeah,
because
absolutely.
We went to IIM Bangalore every year. We were the only ones
yeah.
to go there year after year to hire various analysts every year. So that kind of created, I think now IIM Bangalore is probably the biggest representation in Blackstone in India. So, okay, I see. Okay, now coming to the SM REIT regulations, which I was initially referring to. Tell us, what are these SM REIT regulations, just for our viewers, what they are and why is it that we need them today?
Yeah, so it's a good, so basically the market, there was a gap in the market, which was largely, the gap was on both sides. One is on the investor side. A lot of people had money to invest and there are not good assets to invest in. So aside of the usual financial products. So there was a push from a lot of investors seeking investment opportunities which are new and in a safer asset classes. Then on the other side, there were need for capital. So there were lots of developers and asset owners who needed cash for various reasons. Some developers needed maybe distressed, or some people wanted
Deleverage.
Deleverage or whatever. So there is a need on both sides, on the asset owners and the investors. So which translated to people coming in the middle through fractional platforms, which sort of largely brought the needer of capital to the supplier of capital and put them together. So that model became very attractive only because the asset that we are talking about is real estate and commercial real estate. And India by that time had already established REITs and so on. So there was already some level of awareness of what these instruments are. And so people are comfortable investing in rental producing properties.
Okay.
And people realize that this is an easy way to get much better yield than a fixed deposit.
Yes, plus some capital appreciation.
Plus some capital. So in that respect, the start of the product was it was very easy to kick off, right? But the thing was, after some time, you suddenly had an explosion of different players in the space. And that's when the regulatory hat was put on by our regulator to say, okay, should we get involved in this or not? And I think and as you know, SEBI has 3 objectives, right? First one is protecting the
Investor
investors.
protection, yes.
Investor protection and market development. So I think on that investor protection, on the one hand, they were fighting a lot of battle on alternative investment funds, which are largely products which are sold to high net worth individuals. But at the same time, SEBI has been actively trying to regulate, put more compliance on those products. So it was natural for them to now look at this as another explosion of private market, which could potentially lead some bad outcomes.
Right.
And therefore, SEBI said, okay, let me look at this regulatory. And of course, like the current approach is put out a concept paper, get a lot of feedback, work on the feedback, and then come back with a regulation, which is what they've done.
Right. Yeah, it was a very consultative process, I have to say, in that way. They did take some time, they took all the feedback from the players and so on. And if we were to tell us what SM REITs are, what are small and medium REITs? What do they buy?
So the small medium REITs, first of all, we already have an existing REITs which had a minimum cutoff of 500 crores of assets. So obviously it has to be lower than 500 crores.
Right.
And it has to be somewhat not too small. So they have put a window of between 50 to 500 crores.
Right.
So anybody who is creating a product whereby you're bringing in a whole lot of investors who are going to be jointly investing in a property which is of a rental producing nature would come under this, as long as the size of the asset is below 500 crores.
So all the main board REITs will do all the assets above 500 crores. Correct. And for all those smaller ones which are too small, or developers are smaller, they are not the DLFs of this world. Correct. Or are not sponsored by the GICs of this world, they get access to capital. Correct. Through a small and medium REIT where you could list any small office floor even from
Correct.
50 to 500 crores. And that's what the small and medium REIT is. And the reason why it's important, like you briefly spoke about, is just the amount of real estate that is left unmonetized today in Correct. India is huge. Do you want to talk a little bit about that?
No, that's the most exciting part for me. I think this is an opportunity for India to do something special.
Yeah.
Because if you look at the growth of the country, right, the top people, whether it's the business groups like the Adanis of the world, they have access to capital. Yeah. And they have access to both domestic capital and foreign capital.
Right.
And both formal capital and informal capital. So that part is taken care of. But the bulk of the middle, they are starved of capital all the time. And most of the time they're dependent on banking system.
Right.
And so this is a very interesting product which allows those people to monetize the only asset they have. Yeah. Many of these small businesses, for example, they have the only asset is land that they sit on, which they would have bought 40, 50 years back.
Yes.
And now the land is sitting in their balance sheet at book values. So this is, and right now they couldn't sell the land, right? Because they need to use the land, right? Because that's where the factories are.
Yeah.
But now you have a product which allows them to monetize the value by probably, for example, a small business can actually sell that land and then lease it back for next 40, 50 years. Yeah. Which allows them to use the land At the same time, they've got the capital by unlocking the land that they
which they can use in their primary business.
In their primary business.
In a way, they are in the real estate business without realizing they are in the real estate business. And these values have grown so much over the last 20, 30 years that suddenly they don't look at it because it's all book value and they feel like, okay, it's 100 crore balance sheet with the 5 crore land, but that 5 crore land is probably worth 100 crores today. So, in a way, real estate is a big part of their business without them knowing it.
And the unfortunate part is today, if they had to monetize it, they have to sell it. In which case, they would not have control over the land and they couldn't be using it. So that leaseback part of it is really the attractive part. And then not just the companies, you have governments. I mean, governments, if you look at it, both the local and the state governments, they have huge capital need. And they are sitting on huge amount of, like post offices, for example.
BDA complexes,
BDA,
post offices.
exactly.
The SBI bank right here around the corner has a huge parcel of land on St. Mark's Road Prime, which could be sold probably at 40,000-50,000 rupees a square foot. But, I mean, they have this old sitting on their balance sheet.
And I feel this is a product, if you think through this right and it works out correctly, this can really explode in terms of the capital that can supply to the mid-level businesses, which can then propagate to a GDP growth.
I mean, it's very interesting you say that because last year we bought this asset, Prestige Tech Park, where the tenant was 24/7 and they had built that building themselves. Because in the earlier building that they were, the developer somehow just pushed them out because they were paying low rent, so developer wanted them out. So somehow they figured out something and then they so they had a really bad experience. So they said, we want to own our next asset. No, we don't want to, expose ourselves to rents. So they went and worked with Prestige and they built this beautiful building and they occupied this building, big 500,000 square feet. But after like 10 years, they realized this building is worth 700 odd crores. And this is not our primary business. We are in the, AI, tech business. So why don't we just sell it? So they came to us and said, we will lease it back to ourselves because we want the building. Can you buy the building from us? Floor-wise or in smaller units because we don't want to sell everything at the same time. And that's how the whole thing happened and we bought it from them. So in a way, what you said is exactly how it played out. In reality, for some of these companies, now they're happy. They've got the injection of capital and they're using it.
But if you think of just 124/7, if you multiply by the number of small and medium businesses that we have in India who are sitting on land,
huge.
I mean, you're looking at huge lakhs of crores of capital unlocked.
And if I were to look at it from the retail investor side, which is what SEBI always looks at, how do you think this SM REIT helps retail investors? They were already investing in FOP platforms. What's new? What's different for them?
See, the way generally in India it works is regulatory products provide some degree of protection. Okay, what that protection, whether the protection actually manifests, we do not know. But in general, there is a premium. If you look at private market versus public markets, the public markets have a premium in terms of protection. So I'm
perception
assuming,
of
perception, and also there is a feeling that the regulator will step in if something goes beyond a certain level of egregiousness. And I'm assuming that the same thing will apply here. Whether the investors who are right now on the platforms would care about that, we do not know. So my feeling is that all this regulation is not for the current set of investors. It is about for the future set of investors who are likely to come into this market in a big way. And I can see this, for example, a lot of mutual funds are sitting on, like debt mutual funds are huge. And a lot of them, the only investments they have is either they go to the GSEC and buy government bonds, or they go to these corporate bonds, which are varying. Most of them are investment grade bonds. But now if you throw in another asset class to them, and I think right now mutual funds own a very small part of REITs. I think like 20% or something like that, much less than what they can.
Even insurance companies, by the way.
Exactly. So I'm saying if those guys not directly investors, but indirectly retail investor money through these funds come into this segment in a big way, then you need protection. Because then eventually there are a lot of people who will get hurt if something goes wrong. So I'm assuming the regulation is not meant for the current investors. It is more for the future investors who are likely to come in if things are properly laid out.
Right. And I mean, I don't know if you agree, but I also think that right now through the FOP platforms, they've reached out to a very small set of investors. If you regulate a product and suddenly you have this huge network effect of the distributors, which is how financial products are sold in India, be it mutual funds, you have these advisors calling you tier 2, 3 cities. And suddenly you get access to that network to kind of sell your regulated product. A lot more people will find out about an asset class like this,
Correct, yeah.
which is sort of an alternate. It's not the primary equity debt asset class
Correct,
that people have been investing in. It'll give them access to a whole new kind of group of retail investors.
So in fact, it was an interesting conversation when we had a workshop recently at IIM-B on this particular topic. One of the things that all the fractional platforms were worried about is, look, we have built the whole of this with cutting edge technology. And now you want us to go back to the dinosaur age method of distributing and so on. And in that discussion, actually, I felt, just watching that whole thing play out between the regulator and the platforms, was that here is an opportunity for these platforms to actually disrupt the investment banking business.
Yeah.
I mean, if you think about it right now, I mean, the whole distribution is all very archaic, it's very network based. So if you use technology to break up, then this can actually be another vehicle to bring change to the financial markets, but not directly, but indirectly. And you could do that. Some of these platforms are very good in technology.
I mean, if we look at examples from around the world, in the West especially, this is something that has been existing for some time now in the guise of crowdfunding real estate. And you would have seen some of these platforms in the US. There are quite a few, right? And they have used an underlying regulation from SEC and built a platform over and above that. And then everyone knows that underlying there is, let's say, a regulation, but on top, the whole, platform, everything that they built is all tech driven. So the FOPs need to find a way to have the regulation there, which is great because it gives you so many advantages, but still build a platform around it by disrupting maybe the distribution side of the business, which, like you said, is very archaic. Right now, it's just only 2-3 people control the entire market. And there's no way for another person to enter. So that could be a very interesting.
And we have examples, right? Like we have people like Zerodhas and Grows of the world who have done purely on tech. And they have disrupted businesses which were all, brokerage businesses and other hardcore.
Coming home and signing the form and the guy coming and telling you this is how you open a Demat account. Now suddenly, like 30 minutes, even like 2 minutes, in fact, you can open on Grow and Zerodha through an Aadhaar-based OTP system, which people never really figured out until these guys did it. So that's where the entrepreneur, role comes in to kind of see, okay, let me work with what I have and try to innovate.
I believe SEBI is expecting this. So my feeling is that SEBI they eventually is looking at some of these platforms not to give up on their technological superiority or advantage. They want to actually build this forward.
And how do you think the regulations help FOP platforms? How is this? Because
I think basically the FOP platforms now, as you said, have a common regulation. So previously there was nothing to stop them. So somebody was doing at this level of compliance or this level of safety, and somebody was completely bypassing that because there was no common rule. So having this regulation makes the playing ground level for everybody. So now it's completely up to individual firms, either their technological superiority or their network superiority, to be able to build a business around it. And I'm assuming that will be good only. In the long run, that will help people focus on their core strengths rather than trying to bypass regulation and basically, get the additional returns by doing shortcuts.
I mean, if we look at even other disruptors like Uber or, these other, ultimately regulations caught up with them. They couldn't they grew the business, but without regulation, you can never really build a multi-billion-dollar business. You have to work with the government, and especially in this industry where you're managing people's money, the moment you go there, then it's always an area where the regulator takes a very keen interest on what's happening in this particular. So it had to come at one point of time or the other, but I guess it's really good that it's come now. And I mean, everything depends on the regulator and how little or how much he kind of regulates this market. Just on terms of challenges, I know there has been a lot of questions asked on these regulations from FOP platforms, and there is some angst in the system about what's going to happen and so on. What do you see as some of the big challenges in?
I think the first big challenge would be to what do you deal with existing structures. So these are done by platforms with their investors in a pre-regulation regime, So migration is going to be a big issue.
Right.
I'm assuming that there will be a lot of open questions on how to do the migration with the least cost, and whether the investors will actually want to do that.
Right.
So I think regulators, SEBI has to be cognizant of that, and they have to provide some flexibility on how that migration should work. But going forward, definitely SEBI has drawn the line on the sand.
Right.
On what needs to be done. So I think that also is clear to the platforms now that you have this model. You have to play the game, we have to play these rules, play by these rules. So which I think is good. In terms of other challenges, I think the bigger problem in my mind is some of the things that, for example, not allowing asset owners like developers be the sponsors.
Yeah.
I think SEBI has its own reasons why they are very adamant about RPTs and not having related party between the sponsor and the manager and so on. So I think those are the things somewhere, some flexibility has to, because ultimately this product will only succeed if you bring in good quality assets.
Yes.
That can be now packaged to investors.
Yeah.
And if you don't have that, and the assets are all owned by developers or some other asset owners, so they have to have they're not going to sell it to a platform,
right,
just for the sake of it, right? If they want to monetize it, they would like to also monetize it together with investors,
right?
Some partial monetization, and I think that part should be allowed, which I think that will open the size of the market.
Right.
And then of course the third thing on terms of there are things like skin in the game. I think overall in the longer term perspective that's a good thing.
Yeah.
But in the interim period, these platforms are run like intermediaries where,
Yes.
there is no capital involved. They are largely advisors and so on. So I think, but if you want to suddenly have them have a net worth, many of them have a negative net worth,
Yes.
So in that respect, having a 20 crore net worth requirement might be very stringent.
Yeah.
So it will kill a lot of businesses
Right.
immediately. So again, some flexibility in terms of how that process is managed till we reach a healthy stage where then you can think of the growth.
And if we look at SEBI's approach to these kind of regulations in the past, it is be very restrictive initially, because they don't want to be seen obviously as a very lenient regulator. But over time, after listening to participants, slowly water down these regulations to help the industry grow. From 2014 to the first REIT, there was 4 years. 2018,
Correct,
there were so many representations we made to SEBI. They said the REIT has to directly buy the asset. That's what they first told us. The trust has to buy the asset. But all our assets were in SPVs, including all the other private equity funds. So we told them, look, we have to buy the SPV. If we buy the asset, then it's a 6.6% stamp duty. It's a big implication. 7% of billions of dollars is huge. But they just said, that's it. But after a couple of years, no one really did anything. We kept, and then they realized, okay, this looks like something, it's kind of a thorny issue. So let us, then they said, okay, you can buy the shares of the SPVs. Fine, one layer is allowed. You can't have 2 SPVs, one layering is allowed. So do you see, you've interacted very closely with SEBI. Do you see them watering down these regulations over time?
I wouldn't use the word watering down.
Exactly. Maybe that's not the right word.
The right word would be to have the right regulations for what you need to develop the market and keep it safe. So I think SEBI is definitely cognizant of that, and they will do that.
Okay.
But I think the larger picture is, unlike in the older REITs, the regular REITs, where there was nothing.
Yeah.
And so clearly people were not doing anything. If SEBI had put out a regulation and people thought it was too stringent, they would do nothing. But in this case, slightly it's different, right? Because already the platforms exist.
Yeah.
So you're now trying to push them into a regulated space.
Right.
Which in my mind, SEBI does not have the luxury of time.
Right.
Unlike in the REITs where they could just sit and wait for markets to come back,
Yeah.
So I'm assuming SEBI is much more active in trying to make this work.
Yeah.
But I do agree that, if I was the regulator, I would do the same thing.
Yeah.
Because I would be afraid that
Of course.
if I keep it at a very low level, and there could be always somebody, in India the jugaad is there in regulation.
Exactly.
So people always are looking for the gaps.
Yeah.
So I would rather want to start thing and then see what are the bottlenecks for the growth, and then slowly sort of relax some of these bottlenecks to make it happen. So which I think the only question is they have to do it fast.
Right.
I mean, they can't take 2-year cycles to do that, which I'm assuming this current SEBI with the people in place are very, very active. And
they're very proactive.
They've got their ears to the ground. So I'm assuming that will happen.
Okay. Just separately, I wanted to kind of ask you, have you ever seen a product like SM REIT anywhere in the world? Because I have not. This is the first time I have seen a product like this.
No, I think, the fractional platform is there, the larger, and then there is the other extreme, which is tokenization, which is bypassing the existing systems. So I think you're right, this is a kind of a unique product to India.
Like
but I think it's actually, in my mind, it's a perfect product for India. As I was saying earlier, this is a necessity for a capital-starved mid-India.
Right.
Like middle India, no?
And in India, who loves buying real estate? They all, we all like real estate. We like buying the physical assets. So that way, it's definitely something that's.
But I think I would slightly disagree on that. I think in India, people like the capital appreciation.
Yes.
Nobody likes the rental yields, And I think that's why you have rental yields which are abysmally low relative to
2-3% in residential assets.
Because I think people like that huge, upside in the capital part. But I think that capital part and the rental part will go hand in hand, like the way it goes in the rest of the world, And if capital gets if the prices go too high, then people will rent. It doesn't make sense to buy the asset. And then that rental will start going up, and then at some place it will equilibrate, which is what happens in the rest of the world. In India, it will happen, and I think the more capital is always needed. We need a lot of good quality, both residential space and the office space. I think, for example, if you look at grade B and below the grade A properties, you have huge amounts of, in the secondary districts and so on. A lot of properties which are like 40-50-year-olds buildings, in prime areas. And then on top of it, if you throw the sustainability angle to this, India has boldly put in a 2070 goalpost, right? And then CREDAI has put 2050. Wanting to impress everybody else. So then you have literally you're talking about the next 20 years, 2 decades. How are you going to get all these buildings to become sustainable net zero? So I feel this is an opportunity to bring in capital into these buildings. And because, for example, if you have a REIT which takes over a building and then also brings in some new capital to make them net zero or ESG compliant, then now you have the ability to achieve that net zero target. Otherwise, no way we are going to achieve it. So it's a huge problem.
Okay, just one final question. What's next? Where do we go from here? Where are the fractional ownership platform, SM REIT? What do you think what is your view of the next 3 to 6 months in this industry?
See, next 3 to 6 months, I think there will be a separation in the platforms. I would assume most of them will migrate. Some of them will go under the radar in terms of either sell their assets or keep it below 50 crores. And operate it without this thing. But my feeling is that the larger players, people who have reasonable sized assets under their management, there is no other choice. I think they will have to migrate towards the thing. So migration is going to happen. That migration is going to be costly. Their business models will change.
Will have to change.
Will have to change. People have to bring in capital and they have to run it in a different way than just what they're doing. It's a good thing, because now you are becoming an asset manager than from being just a platform. The only thing I would hope is they don't give up on their technical superiority.
The tech should.
The asset manager is a state business. And people can be asset managers, but with high technological superiority. And if they do that, then I think they will change the asset management business. And in fact, I'm seeing that as the sort of the major change. It's not going to be the fractional asset ownership. It is going to change the way assets are sold in India. The way it is marketed, and so all these intermediaries are all going to be decimated with technology, because now everybody in India has a smartphone. And I think this business is very old school.
Yeah.
And I think it's ripe for a disruption.
Yeah, and that's what we are all kind of aiming for, like a very efficient market where technology kind of just differentiates itself. But in terms of like, you saw so many of the fractional platforms in the workshop that you held along with SEBI. Do you feel like there will be consolidation as well here? Do you think so many of them will exist, or do you think some of them, because for a new guy to have a 20 crore net worth, I mean, even if we started today, we would not have qualified. I mean, where would we raise 20 crores from?
Right. So I think my feeling is that, see, this platform will, I mean, whoever is running a business in this space, he's going to be as good as the asset they bring to the table.
Right.
I think the investors' pools are there. So the asset is going to be the determinant. So it is going to become, that's the consolidation part. So it is not because of the regulation. It is, they all are going to chase the few good quality assets.
Right.
But because the ticket size of these assets are small, I'm assuming, for example, you may be very hard to play the game in Indore, or Raipur or some other, because there will be, I mean, there is a huge fixed cost for you to operate at those cities.
Yes.
So you're going to have a lot of players playing that game in those places. There are lots of different office spaces across the city with reasonable rentals.
Right.
So my guess is that the consolidation is going to happen in one way, but there's also going to be a huge distribution, purely because it's impossible for somebody to run it at a national level because of the small ticket size.
Right.
See, in a larger REIT, I can totally see this, the consolidation, because you need 1,000, 2,000 crores of assets. It's very hard. You can easily pick.
Yeah.
And Blackstone can play the game nationally.
Right.
But in a small REIT, it's impossible for a guy who's in Bangalore based to fight the battle in some southern city or or in Assam or something.
Right.
It's incredibly difficult. So I'm assuming you're going to have a lot of good players coming at various nodes.
Localized
players, because they have the access to the asset. So ultimately, the asset is going to drive the success of this business.
Right. Great. On that point, we'll end the podcast. Thank you so much, sir, for joining us. And I mean, both of us, I'm sure, are very excited about what's going to happen in this industry. We've seen this play out over the last few years, and now, I mean, I want to see what happens. In the next 3 to 6 months. We are in the eye of the storm, so to speak. So we will see firsthand whether we'll be swept away or whether we will kind of rise above, and become like a regulated product that suddenly disrupts the market and retail investors get access to something they've never got before. It's pretty much inventing a new asset class that the regulator has done on the back of what the FOPs have been doing. So, and that doesn't happen very often. I mean, when have we last heard about a new asset class being invented? I can think of CDOs or junk bonds by Michael Milken in the 80s and so on. But, once in a decade, you get like a new asset altogether, which is now happened in India of all places. So very excited to see how that plays out.
Let me just say one last word. I think just my advice to all the platforms.
Right.
I think playing a regulated space requires a different mindset and different operational capabilities. I think you should put a lot of bandwidth on that upfront, including compliance and so on, because these are the small things. You guys can easily do it, but don't miss it, because most of them are startups and they operate in a non-regulated space.
Yes.
They're used to moving fast and things like that. But I think this is a space where the market size is so huge that you want to play the long game.
Yeah.
Don't play the short game.
The academic in you has finally come out towards the end of the podcast, and very, very sage advice for all of us in the industry, and I think something we should all kind of take very seriously when as we move ahead. Okay, on that note, thank you so much for joining us for this podcast, and we hope to see you again soon. Thank you.